My name is Jim Lear, and I'm with Guideway Financial Sciences. You can learn about us at portfolioandplanning.com. What I'm going to talk about is why small market changes can cause large price swings. The motivation for this is that oil prices have been swinging violently over the last few years, and that speculators are getting blamed for this. The president has even created this working group to identify fraud and manipulation in the market, yet there's been no evidence that fraud and manipulation have any relationship to the global market swings that have occurred. It's at the same time I was developing a model that described the stock price volatility, and it's perfectly applicable in this scenario as well. The traditional view of supply in textbooks is usually described as a straight line or maybe a curved line, and it describes the relationship between market prices and the number of units that would be produced. So if the good or services is trading at $20, then this supply curve would indicate that about 500 units would be produced. If the price rose to $40, then the production would increase to 700 units per year. The important thing here is that as price goes up, that the supply goes up as well. Similarly, there's a demand curve. The main difference between the supply and the demand curve is that as the price goes up, demand goes down. Here we see that at $20, 800 units will be consumed, but at $40, only 600 units will be consumed. When we overlap the supply and demand curves, the intersection dictates the price and the number of units that will be produced. In this example, the market price is set to $35 and the number of units produced is 650. If there's an increase in demand, there'll be a commensurate increase in prices and units produced. However, this model fails to predict the behavior when we reach the limits of supply and demand capacities. In order to derive the improved view of supply, we'll talk about the hypothetical cost of producing oil. We don't have to know the exact cost to see how price volatility can occur. The gold bars represent the number of oil wells that can produce oil at a particular cost. The brown bars represent the total number of wells that produce at or below a cost. For example, say there's only one oil well that can produce oil at $17 a barrel. If the price of oil is at or slightly above $17, then the total production will be 1 unit per year. Imagine that there are 2 oil wells producing at $18. If the price is at $18 or slightly higher, then there will be 3 oil wells in production, 2 at 18 and the 1 at 17, and so on. Say there are 4 oil wells producing at $19. A market price of slightly above $19 will mean that 7 units will be produced, 4 at 19, 2 at 18, and 1 at 17. If we extend the curve over the entire price range, we'll see that the oil wells have a distribution of costs that's similar to a log normal distribution, as shown by the gold bars. At the low end, there won't be many oil wells because it's very difficult to find inexpensive oil wells. At the high end, there will be few wells because expensive oil wells are less attractive for 2 reasons. Obviously, there's less profit in expensive oil wells, but there's also more risk. If the price of producing oil is near the market price, a small drop in prices may cause the oil well to lose money. Hence, the probability of losing money is higher and the reward is lower. If we add up the gold bars going from left to right, the gold bars get smaller and smaller, and the brown bars begin to level off. This leveling off represents the supply limit. There's simply no oil that can be produced beyond a certain point without drilling more wells. Of course, wells can be drilled, but those take time. But on a day-to-day basis, the supply is relatively fixed. In a similar manner, we can derive the demand curve. There's a total demand, and we can think of the total demand as the total number of trips that people will take. The gold bars on the left side are the recreational trips that are easy to eliminate. As we move to the right, the trips become more important, such as commuting to work, emergency trips, or military missions. There's a limit to consumption on the left side because consuming oil costs money and time. For example, it costs wear and tear on vehicles. So at some point, demand will reach its limit. Like supply, this curve can change over time as people purchase new energy-efficient vehicles or alternatively purchase more powerful vehicles. But on a day-to-day basis, this curve doesn't change much. If you overlap these curves in the fashion demonstrated here, it looks very similar to the traditional model. In the region of the intersection, the curves look like traditional straight line models. A change in total demand will cause a commensurate change in production and in price. However, we can imagine a scenario in which the curves don't overlap in the rising and falling areas, but instead overlap in the regions of supply and demand capacity limits. In this scenario, if the demand begins to exceed supply, then we can see a tiny change in production and consumption, yet enormous changes in prices. What happens when demand begins to dominate the market? The new high prices not only increase the profitability of new oil well development, they also reduce the risk. So oil companies will begin to develop more expensive oil wells. When they develop these new reserves, the capacity will increase and the prices will ease. They probably won't go back to where they were before, but the prices will ease some and shortages will be avoided. We've talked about how small changes in the market can cause large price swings, but large changes have been occurring in the oil market. This chart shows the U.S. and Chinese oil consumption over the last few decades. The U.S. oil consumption has increased gradually over this period, but the Chinese oil consumption has grown rapidly, and it's set to surpass the U.S. consumption in the next few years. This, along with the new market model, make it clear that normal market forces are probably behind the price increases in oil over the past few years, not speculation. Let's talk about what I see are the beneficial roles of speculators in the market. What speculators do is that if they believe the market price will be going up, they purchase the asset or take bullish positions in derivatives in the hopes of selling at higher prices. That drives the price up faster, but it doesn't drive the price up beyond the new equilibrium point. If the price gets beyond the equilibrium point and it gets too high, speculators don't care which direction the price is moving, and they'll drive the price down as quickly as they drive it up. When they see the price going down, they'll sell the commodity short or take bearish positions in derivatives in the hopes of profiting from lower prices. This helps drive the price down faster, and it prevents prices from getting too high or too low. Their acceleration of price movements is highly beneficial. This rapid response instantly notifies consumers that they must reduce consumption, and it also notifies producers that they must increase production. The sooner and more quickly this is done, the more rapidly the market can respond. If those signals are not sent rapidly when prices get too high, consumption will continue to grow while production may be sluggish to grow. Shortages may result, and there may be long lines at gas stations. Imagine a cruise control in an automobile that takes miles to respond to hills and valleys. One might hit a hill, and the cruise control may not begin to increase power until the top of the hill is reached. At that point, it will continue to add power as the car rapidly accelerates down the hill, increasing the speed well beyond the target. This slow response can cause instability in the system. On the other hand, a rapid response prevents shortages and gluts in the market, and it reduces large swings in the marketplace. In conclusion, we've seen how the new supply and demand model can explain large swings in prices with very small changes in production and consumption. Furthermore, large changes have occurred in the market. China has become an enormous consumer of oil. This casts serious doubt on the proposition that speculators are manipulating the market. These new models can also be used in any market, from housing to tulips, and can be useful in understanding the conditions in which may cause large price changes with little apparent reason. I hope you've enjoyed this video, and if you have any questions or comments, I'd love to hear from you at jim.lear@portfolionplanning.com.